Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. Certainly will be a busy Thursday morning in the Asia Pacific. U.S. equity futures are higher. That's after strong earnings from both Meta and Microsoft. Meantime, the equity market stateside finished mixed. That was after the Fed held its policy rate steady. And then later in the day, President Trump announced a trade deal between the U.S. and South Korea. And in a moment, we'll get some reaction from Naomi Fink. She is the chief global strategist at Nikko Asset Management. But we begin here in the States, and Fed officials leaving interest rates unchanged. They also downgraded their view of the American economy. Interestingly, the tone in Powell's press conference skewed a bit hawkish.
Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer-run objective.
Now, Powell went on to say that no decision has been made with regard to a rate cut in September. And as he spoke, the market gradually reduced odds for that cut. It's now seen as basically a 50-50 event. Let's take a closer look at market action now and reaction to the Fed's decision. Joining me is Dean Smith. He is the chief strategist at FolioBeyond. He's on the line from here in New York City. Dean, thank you so much for making time to chat. This is pretty much what the market had been expecting, although we did have two members of the committee dissenting. The first time that's happened in over 30 years. We had Governors Chris Waller and Michelle Bowman favoring a quarter-point rate cut. But overall, it wasn't really a surprise. Is that how you saw it?
Yeah, the July rate cut went off the table at the prior jobs report. This was exactly what the market was expecting. I mean, Powell just said it himself in the clip you just quoted. The economy's doing pretty well. I mean, financial market conditions are pretty good. People can get access to credit. Inflation is a little above its target, and the official numbers probably are understating inflation. So, and we've got full employment, of course. So given that backdrop, there's not really any reason for the Fed to cut rates right now, other than, the political pressure that they're getting from the administration, which is pretty severe, but so far they've managed to mostly ignore it.
But we're in the midst of these trade deals, and we just had a deal today, which we will hear more about momentarily, with South Korea, where a 15% tariff will be put in place. And at some point, that could trickle down and actually create inflationary pressure, could it not?
Well, yeah. I mean, the thing with these tariffs is we haven't really seen much of the effect. We're starting to see it now. GM last week said that they had a $1 billion hit. Ford, I think it was today, said they had a $2 billion hit. So they're starting to bite. But we've got a couple of things with the tariffs. First of all, we don't actually have final agreements. We've got, sort of a statement of intentions. And there's a lot of uncertainty about where these things are actually going to land. So we don't really know what the trade deals are going to be. Second of all, if these tariffs come in as they're being advertised and announced right now, or if they're increased any further, it's going to start to show up towards the end of this year and into next year. These supply shocks and price increases take a long time to work through the supply chain. There's a bunch of steps. It's not as if a tariff of 15% gets announced and all prices magically increase by 15%. First it's the guy at the port, then it's the guy down the line producing intermediate goods, and then it's the retailers, and it has to work its way through, and that takes quite a lot of time. So the Fed is watching that, and that's what they're supposed to be doing.
Well, as part of the South Korean deal, President Trump said that the country will be purchasing $100 billion in liquefied natural gas and other energy products. There was a similar story where the trade deal with the European Union is concerned. And I'm wondering if we can talk a little bit now about what these other countries are willing to buy from the United States, and maybe at the same time to address this idea that we're going to see some foreign direct investment flowing into the U.S. Is this a net positive in both instances?
Well, I have to tell you, the liquid natural gas is kind of interesting because they announced, I think it was $125 billion per year to the EU, and then another really large number here to Korea. Total exports to the world of LNG by the U.S. last year was about 50 billion. There is not the capacity to produce, ship, store, make use of anywhere near the amount of LNG that is being talked about as they announce these so-called trade deals. So that is a bit of, let's be generous and call it puffery in these announcements. But when you get back to the other question about direct investment, I mean, if you're running a trade deficit, you're going to accumulate dollars as a foreign country, right? What can you do with dollars? Well, you can make investments in US dollar denominated assets. And that's what countries have been doing. They've been accumulating government bonds. They've been buying, in the case of China, they've been buying farmland. So these announcements are basically describing what's already happening in the economy. There's to think that you're going to have entirely new net investment of the magnitude that's been coming out of these announcements is, again, it's just not real.
Let's change gears, talk about some of the earnings that we had here in the U.S. after the bell. Two big ones. Microsoft up first with better than expected growth in the cloud business, Azure. I think sales in the unit were up 34%, and we're talking about total revenue for the year that ended in June at $75 billion. This is all about AI. Is this, in your view, still going to deliver the momentum that we have seen over the last, let's say, 18 months? Or are we at a point now, given all of the investment that this company has made in AI infrastructure, that we've got to be a little bit more careful here about the return on investment?
Well, when you talk about the AI explosion that we're experiencing here, and you pointed to Microsoft and the Azure platform, you've also got the Amazon with their AWS. These are the guys that are selling the pickaxes and the shovels to the gold miners, okay? And that's always been a great business. And so the ability of these companies to continue to grow those cloud computing platforms is pretty positive. I think that's a real bright spot. The biggest problem with AI and the valuations that are on some of these companies is actually the energy generation. That is going to be the constraint. And the amount of energy that has to be generated and then transmitted, you're building these massive data centers. I haven't seen anybody who's quite figured out how that's all going to work. So I'm a little bit from Missouri when it comes to, some of the biggest AI valuations. You got to show me, because it's not clear to me how it's all going to get built out.
If you're questioning AI, then, Dean, I'm curious about other areas of the market that you feel are attractive right now. Would you put energy generation, power generation into that arena?
Well, I'm not questioning AI per se. I think AI has just an amazing potential to enhance business, individual life and the internet, all sorts of things. In medicine, there's all kinds of potential. But like anything, it's going to be a big challenge logistically to get from where we are to there. In addition, AI right now is a little bit like the railroads, 200 years ago or 150 years ago. There were a lot of companies building a lot of railroads, and only a handful really survived the shakeout. So I expect something similar is going to happen in AI. Energy generation is clearly something that has, it's sort of generic. Anybody can use it. But when you talk about individual AI companies that are actually building these models and deploying these models, I'd be a lot more cautious there.
Let's talk a little bit about the bond market. There's been a pretty fair amount of volatility in U.S. Treasuries and in some corporates lately. Today, we had yields actually pushing higher across the curve. I think the market's kind of dialing back from the notion that September is a done deal now in terms of a rate cut. We'll have to wait and see what the data kind of tell us about the strength of not only the economy, but the outlook for inflation. Are you looking at the bond market for opportunity these days, or are you more focused on the equity side?
No, we're actually principally fixed income guys. The funds that we manage are all invested in fixed income assets. So we're very keen to have a view on where we think rates are going. The bottom line here is that people are waiting for a return. Not everyone, but a lot of folks are waiting for a return to the extremely low interest rate levels that we saw in the aftermath of the financial crisis and then through COVID. We're not going back there. The interest rates that we see today, call it 4 3/8 to 4.5 on 10s and pushing towards 5 on the 30-year bond. Those are kind of normal rates historically. If you go back and look, the anomaly was the 1% and 2% rates, and the normal rate is about where we are right now. We don't see any way, barring some sort of, another crisis, to get back to those really low rates. People need to reorient their thinking and accept the fact that we're going to be in this higher interest rate environment for the foreseeable future.
So is it the middle of the curve then that where you want to kind of hide out, at least for the near term?
Well, what we think makes a lot of sense is to not take on a lot of interest rate risk, a lot of duration, as the term of art is. We think that, staying a little shorter, staying, inside of 10 years for sure. And we think it also makes sense for most investors right now to find ways to generate income. Okay, we think that income is going to be the key to making it through this rough patch here, as opposed to, other sorts of sources of return, finding the next NVIDIA, finding ways to really swing for the fences. We think that it makes much more sense to stay close to home, generate income, and let the power of compound interest do its work while we figure out sort of where we're headed in this new global economy. Okay, we'll leave it there. Good stuff. Dean, thank you so much. Dean Smith, he is the chief strategist at FolioBeyond, on the line from here in New York City on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. As mentioned, the U.S. has reached a trade deal with South Korea. A 15% tariff will be placed on South Korean goods being imported into the U.S. In a post on Truth Social, President Trump said Seoul has also agreed to invest $350 billion into the U.S., and Trump said South Korea will purchase $100 billion of liquefied natural gas and other energy products. Now, from the other side of this deal, President Lee Jae-myung said the agreement eliminates uncertainty in South Korea's export environment. Let's get some perspective now. We heard from Naomi Fink. She is the chief global strategist at Nikko Asset Management. She spoke with Bloomberg TV host Shery and Haidi Stroud-Watts on the Asia trade.
Naomi, always good to have you with us. Can we expect the markets to take all of the latest trade news positively and just find an excuse to rally again?
Well, at least if we take a look at better than expected data out of the U.S. and Japan, then it does appear at least that some of the fears, at least immediately, aren't manifesting. The only thing is that markets have rallied quite a lot already after the Japan trade deal, possibly in excess of the good news presented by that deal. And what we've seen with Korea is very similar. It seems like 15% is the level that signals not as bad as feared. So a lot of that is priced into markets at the moment. So right now we probably maybe need new additional news to go any further. And conversely, it's possible that we're a little bit overstretched and we might be vulnerable to corrections if we get bad news.
Where would the catalyst potentially come from?
Well, we do have economic data coming out from many directions. We still have some out of the U.S. later this week as well. So I think we could still get minor corrections if we do have disappointments. If, for instance, the market decides that yes, we had strong data, but that also disincentivizes the Fed from cutting anytime soon, then the stock market can get a little bit wary. That That said, it's not as if we saw anything that is really groundbreakingly bad news. So it's possible that just supply and demand conditions and overstretched positioning might correct a little bit. But so far, we haven't seen any large catalysts to make any structural change.
The Bank of Japan continues to normalize policy or hopes to. What sort of implication does that have for the markets here, which, as you said, have already been pretty stretched?
Well, the Bank of Japan's policy is accommodative, and the Bank of Japan has said this many times, and there are many signals in the market and in economic data. For instance, inflation remains above target and has been above target for quite some time. So even if the Bank of Japan has the luxury of waiting, of timing the rate rises, we're still on a rate hike trajectory. So the Bank of Japan probably doesn't want to put it off forever because we are above target and households are feeling the pinch of inflation. So eventually the inflation is the central bank's bailiwick, and the Bank of Japan's mission is going to be to keep prices stable. So in order to do that, they at some point do need to hike rates.
What do you make in terms of the relief rally or the complacency rally that we've seen in many other markets but perhaps haven't played out when it comes to Europe and Japan, despite these two countries or areas now having trade deals? Does that change the investing outlook at all when it comes to having these deals now kind of at least taking shape?
Well, I would probably de-emphasize smaller, shorter-term moves at this moment because there can be some overextension and correction in various markets. What I would say is that if we take a look at valuation in U.S. markets, that's palpably higher. It's very visibly higher than valuation in Japan or in Europe. So if we're looking for a vulnerability to some large catalyst, I don't know what it is yet, then the U.S. is probably more vulnerable than Japan or Europe, which is valued a lot more conservatively at the moment. I think that there are probably some strong structural arguments in Japan and in Europe that are not bearing as spectacular immediate fruit as, for instance, some of the recent earnings in the U.S. tech sector. That said, we shouldn't discount that structural improvement over time, and these markets might prove areas for valuable diversification if we do have U.S. equity-heavy portfolios, as most equity investors probably do. So I wouldn't look at it as a zero-sum game type thing, but I would see, even in the less exciting markets in Japan and Europe, some real structural improvement stories that's worthwhile participating in.
Does the U.S. exceptionalism story kind of persist despite all of the talk about its demise, or do you see perhaps some further upside for some of the arguably undervalued markets like China?
Well, if we take a look at the, I guess, the idea of exceptionalism, yes, the U.S. has been exceptional in many ways, and part of that has been this above-trend growth post-pandemic. And we've seen a lot of investment into the U.S. to compensate, and we have seen that valuation rise. The only thing is that sort of already happened, so it's really more important what happens in the future. And with valuations at current levels, it's not for certain that we will see that follow-through, the performance on all of these hopes for things like the technology, AI, to come before, for example, a U.S. recession. It's possible, and I think very probable, that the investments made to date in technology in the U.S. will bear fruit and productivity in the U.S. will rise more broadly. It's just that hasn't happened yet, and most likely economic cycles aren't dead. So it's a bit of a horse race between what comes first, that broadening of productivity in the U.S. or recession. And if it's recession, that doesn't mean that the productivity broadening won't happen. It's just that it's going to be a bit of a rockier path to get there.
We have seen a little bit more focus on Chinese tech companies, but given, of course, talking about economic cycles, the downside there, is this a market that investors should still be watching at the moment?
Well, I think China is too big an economy to ignore. And I think at one point when investors were looking at China as uninvestable, that we had gone too far. China does have some problems, for example, deflation and weakness in the consumer sector, and that's still deflating property market. That said, China has some options, for example, offering fiscal stimulus, especially for consumption. I know that China has been reluctant to do this, but that might be a good solution going going forward, especially given what's going on the trade side. Domestic consumption is a pretty good buffer when you do have external uncertainty. So I think they still may go there, even despite the reluctance to date. And that would be supportive for both the Chinese economy and assets.
Naomi, always great to have you with us. Naomi Fink, Chief Global Strategist at Nikko Asset Management.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.